11.88% of FHA borrowers in America are now behind on their mortgage. That's straight from the May 2026 Mortgage Bankers Association National Delinquency Survey. And folks, the writing is on the wall. The biggest mortgage collapse in U.S. history just entered Phase 4. And last week, the former acting president of Ginnie, Sam Valverde, warned publicly that the mortgage system is, quote, not ready for the next housing downturn. This phase is different than anything we've covered before because this time the pressure isn't just on homeowners, it's moving straight into the mortgage machine itself. The lenders, the servicers, the guarantors who fund every single American mortgage. Every homeowner, buyer, and real estate investor watching needs to pay attention. 3 things today. Number 1, the exact math on how a single mortgage lender can lose over $100,000 on one loan without a single borrower missing a payment. Number 2, the specific policy change Ginnie just made in March that tells you regulators already know what's coming. And number 3, the controversial call we're making on where the next mortgage crisis will actually come from. And it's not where most housing analysts are pointing. Stick with us. Let's get into it. Let me set the table before we get to the plumbing side, because to understand why Phase 4 is happening, you have to see the pressure that's building underneath. That same Mortgage Bankers Association survey showed the overall U.S. mortgage delinquency rate at 4.44%, up 40 basis points year over year. But here's what really matters. FHA delinquency hit 11.88%. That's up 126 basis points in a single year. And to put that in perspective, that's roughly 900 basis points higher than the conventional delinquency rate of 2.75%. Think about that. Roughly 1 out of every 8 FHA borrowers in America is currently behind on their mortgage. And it's not stopping there. Adam Data Solutions dropped their mid-year 2026 U.S. foreclosure market report on July 16th. And the numbers are eye-opening. 227,548 foreclosure filings in the first half of 2026. That's up 21% year over year and 28% higher than the first half of 2024. Foreclosure starts jumped 18%, and completed bank repossessions, the actual REOs, surged 33%. Adam CEO Rob Barber said, quote, foreclosure activity continued to increase in the first half of 2026. Adding that homeowners may be facing greater financial strain than they were a year ago. Now, here's what most housing analysts are missing. Cotality, formerly CoreLogic, just released their Homeowner Equity Insights report on July 23rd, showing total U.S. homeowner equity at $17.9 trillion. On the surface, that looks strong, but dig into the state-level data, and it tells you a very different story. In the most recent Homeowner Equity Report, Florida homeowners lost $29,400 in equity in a single year. Cape Coral and Ocala, which we covered in Phase 3, are still leading the country in negative equity increases, with roughly 1.2 million American homeowners underwater on their mortgage nationally. So the national number looks fine, but the concentrated pressure at the FHA borrower level and in specific Florida metros is very real. Delinquency is climbing, foreclosures are climbing, equity is bifurcating. And here's what most analysts are missing. This borrower stress isn't the story anymore. It's the fuel. The fire is starting somewhere else. And this is exactly why Phase 4 is happening now, because pandemic-era loss mitigation just ended. Let me show you what that means. For years after 2020, if you fell behind on an FHA loan, you had a lot of options. Multiple modifications, extended forbearance, a very forgiving path back to current. That's gone. In October 2025, HUD implemented a new rule limiting FHA borrowers to just one loan modification every 24 months. Then in February 2026, they added a mandatory 3-month trial payment plan requirement before any permanent modification can happen. And on June 23rd of this year, HUD issued Mortgagee Letter 2026-08, which for the first time counts a third failed trial payment plan as a full failure. That gives servicers just 90 days to either approve another workout or start foreclosure. Think about what that means. The borrower who could get 3, 4, 5 bites at the apple during COVID, that borrower is now on a much shorter path from default to foreclosure. This is the mechanical reason FHA foreclosures are ripping higher. It's not that borrowers suddenly got worse, it's that the safety net got smaller, and it happened while people weren't watching. Now, let's get to the first thing I promised you. How can a mortgage lender lose over $100,000 on a single loan without a single borrower missing a payment? This is the buyback story, and it's the single most important piece of the Phase 4 puzzle. Here's how it works. When a lender writes a mortgage, let's say a $360,000 loan, they typically sell it to Fannie Mae or Freddie Mac within 30 days. That's how they get their money back to lend again. But when they sell that loan, they're guaranteeing to Fannie and Freddie that every single underwriting requirement was met, every income document, every appraisal, every disclosure. Now, here's the part that nobody's talking about. If Fannie or Freddie later reviews that loan and finds a defect, even a paperwork defect, even years later, they can force the lender to buy that loan back at full face value. And it happens more than you think. Analysis from Insider Mortgage Finance showed Freddie Mac repurchase demands surged 29% in a single quarter. One wholesale lender told HousingWire the Freddie problem, quote, has accelerated 10 times, that their Freddie Mac requests were up 100% month over month. Here's the math that should shock you. According to an Urban Institute analysis published in National Mortgage News, the average loss to the lender on each repurchase is around 30% per loan. On an average loan that's over $100,000. On a high-cost loan over $300,000. The loan is still performing. The borrower is still paying, but the lender has to buy it back at par and sell it at a 5 to 7 point discount as what's called a scratch and dent loan. Every quarter, this is happening to lenders across the country, and the smaller lenders, the ones without deposit funding or a diversified balance sheet, cannot absorb it forever. Real quick, if this market intel is helping you make better decisions, hit the notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. Now, let's talk about the servicers, because this is where the plumbing gets even more fragile. When you make a mortgage payment, you're sending it to a servicer. That servicer collects the payment, sends it to the bondholders who own your mortgage-backed security, manages your escrow, and this is key, advances principal and interest to those bondholders even when you don't pay. If you go delinquent, the servicer still has to send that check to Wall Street every single month out of pocket. For big banks, that's fine. They have deposits. They have diversified income streams, but over 85% of Ginnie Mae mortgage servicing is now handled by non-bank servicers, monoline servicers, companies whose entire business is servicing mortgages, and they have no deposit base to lean on. Which brings me to the second thing I promised you. In late March, Ginnie Mae issued a policy called APM 26-06 that most housing analysts still haven't caught. That policy temporarily excludes FHA trial payment plan loans from the delinquency ratios Ginnie Mae uses to police its issuers. Let me translate that. Ginnie Mae just changed the math to keep non-bank servicers from failing their compliance tests. This is not a routine adjustment, folks. That is a regulator adjusting the fire alarm because the fire is getting bigger. And here we go. But wait, it gets worse. Because most housing analysts are looking at the wrong data set. The Intercontinental Exchange Mortgage Technology June 2026 Mortgage Monitor, released just this week on July 24th, shows the national delinquency rate at 3.55%, actually below the pre-pandemic June benchmark of 4.16%. It shows new FHA defaults down 15% year over year. And a lot of housing analysts are going to grab that headline and tell you everything is fine. But here's what they're missing. The data set measures the front end of the pipeline, new defaults, early stage delinquencies. What it doesn't measure is the pressure building behind the scenes at the servicers who have to advance payments on the millions of loans already delinquent. It doesn't measure the buyback demands hitting lenders' balance sheets. And it doesn't measure the fact that FHA borrowers who redefault after a trial payment plan now go straight to foreclosure. The front door of the house looks calm. The plumbing behind the walls, it's starting to leak. And that is the exact story of every credit event we've seen in modern history. It never announces itself. It shows up in the boring reports first, the servicer advance reports, the buyback disclosures, while the headlines still look normal. Which brings me to the third thing I promised you, and this is the controversial call, so I want you to hear us clearly. The next mortgage crisis is not going to come from borrowers. It's being pre-wired inside the lender's plumbing right now. And I know that goes against what a lot of housing analysts are telling you. Logan Motoshami at Housing Wire has been calling this a fake foreclosure crisis for months. And we actually agree with him on the borrower side. The numbers don't support a 2008-style borrower collapse. But he's looking at the wrong side of the ledger. The pressure isn't on the borrower anymore. It's on the machine that funds them. FHA delinquency at 11.88%, foreclosure up 21%, GSE buybacks that can wipe out $100,000 on a single performing loan, monoline servicers with no deposits, Ginnie Mae changing its own math to keep issuers in compliance, and the former acting president of Ginnie Mae himself saying publicly on the record that the system is not ready. Nothing has broken yet, but every warning light in the mortgage machine is flashing. And that gap between flashing lights and no fire is exactly what Phase 4 is. So let me talk to you directly, based on where you sit right now. If you're a homeowner, the near-term risk is not equity loss. For most of you, your equity is fine. The risk is your servicer. If your loan is with a smaller non-bank servicer and they hit liquidity stress, your servicing rights can transfer overnight. That means new payment portals, new escrow analysis, potential chaos if you're in the middle of a modification or workout, especially FHA borrowers. After Mortgagee Letter 2026-08, the safety net for you is thinner than it's been in a decade. If you're a buyer, understand this. The credit box is tightening at the margin. D.R. Horton's SVP of Communications, Jessica Hansen, said on their April earnings call that the vast majority of their cancellations are buyers who can't qualify in full doc underwriting. Get pre-approved with a bank, not just an online lender. Have a second lender in your back pocket. The decisions you make in the next 12 months could save you or cost you tens of thousands of dollars. If you're a seller, deal fall through is your enemy right now. Every marginal buyer who can't clear underwriting kills your closing. Lennar's builder incentive rate hit 12.9% last quarter. That's what the big builders are doing to keep deals from collapsing. Price aggressively. Because in a tightening credit market, the pool of qualified buyers shrinks every single month. Bookmark this video, come back in 6 months, and check every one of these numbers we just showed you. The FHA delinquency rate, the foreclosure filings, the buyback demand data. Because in Phase 4, the story is in the boring reports, not the scary headlines. Watch the plumbing, not the panic. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops, and watch this one next. We'll see you next time.